Preparing for a risk analyst at MAPFRE interview? You've reached Candy Mentor, and this video is for you. We'll walk through 20 key questions you're likely to face. For each question you'll see a sample answer followed by the key points to cover. Subscribe, like, and share, and drop a topic request in the comments. Question 1. What does a risk analyst do in an insurance company like MAPFRE? A risk analyst helps the insurer understand whether its risks are properly identified, priced, controlled, and supported by capital. I would analyze underwriting, market, credit, liquidity, operational, and emerging risks, then monitor limits, trends, and stress results. At MAPFRE, I would also connect analysis to Solvency II requirements, risk appetite, and business decisions across countries. The role is not just producing reports. It is providing clear, timely insight that improves resilience and protects policyholders. While answering, focus on identifying, measuring, monitoring, and reporting risks. Explain the connection between analytics, governance, capital allocation, regulatory compliance, and decisions made by underwriting, investments, and senior management. Question 2. How would you explain MAPFRE's main risk categories? I would group MAPFRE's risks into insurance risk, financial risks, and non-financial risks. Insurance risk includes pricing, reserving, catastrophe, and lapse uncertainty. Financial risks include market movements, counterparty default, and liquidity pressure. Operational, cyber, conduct, strategic, and reputational risks can arise from processes or decisions. I would also highlight concentration and correlation. A severe catastrophe can affect claims, liquidity, reinsurance recoveries, and investment values simultaneously. That interconnected view is essential for enterprise risk management. Make sure to cover insurance, market, credit, liquidity, operational, strategic, reputational, and concentration risks, while distinguishing risk sources and showing how correlations can amplify total exposure. Question 3. What is Solvency II, and why is it important for MAPFRE? Solvency II is the European insurance regulatory framework designed to ensure insurers hold capital appropriate to their risk. Pillar 1 covers quantitative valuation and solvency requirements, Pillar 2 covers governance and risk management, and Pillar 3 covers reporting and disclosure. For MAPFRE, it provides a consistent framework across relevant businesses, supports policyholder protection, and informs capital allocation. I would treat compliance as a management discipline, not merely a reporting exercise, because the results influence underwriting and investment decisions. In your answer, cover the 3 pillars: risk-sensitive capital requirements, governance, supervisory reporting, market-consistent valuation, and how Solvency II supports policyholder protection and disciplined risk-taking. Question 4. What is the Solvency Capital Requirement, or SCR? The Solvency Capital Requirement is the capital needed to absorb an adverse one-year loss event at the regulatory confidence level under Solvency II. It combines market, life, health, non-life, counterparty, and operational risk modules, allowing recognized diversification benefits. Eligible own funds are compared with the SCR to calculate the solvency ratio. I would avoid treating a higher ratio as automatically better. The right level must reflect risk appetite, business plans, stress results, and management's confidence in capital quality. Be sure to mention the one-year confidence level concept, market, underwriting, credit, and operational modules, diversification benefits, and the difference between SCR, eligible own funds, and the solvency ratio. Question 5. How would you assess whether an insurer has sufficient capital? I would begin with the solvency ratio, but assess it alongside capital quality, regulatory thresholds, internal appetite, and the reliability of projected own funds. I would review the SCR composition, diversification, foreseeable dividends, business growth, and liquidity position. Then I would run stresses such as catastrophe losses, equity declines, spread widening, and higher inflation. A strong assessment asks whether capital remains adequate after shocks and whether management can respond without weakening policyholder security or strategic flexibility. Focus on solvency ratios, capital quality, regulatory and internal thresholds, stress testing, liquidity, projected earnings, dividend plans, risk appetite, and the sustainability of capital under adverse scenarios. Question 6. How would you perform an underwriting risk analysis? I would analyze underwriting risk by comparing exposure, premiums, claims frequency, severity, and loss ratios across products, geographies, channels, and underwriting years. I would investigate pricing adequacy, policy terms, inflation, claims development, and changes in portfolio mix. For property business, I would add catastrophe accumulations and geographic concentrations. Finally, I would consider reinsurance protection and retention levels. The output should explain not only whether losses increased, but which drivers changed and whether management can correct them. Discuss exposure data, pricing adequacy, claims frequency and severity, reserving uncertainty, portfolio mix, policy terms, historical loss ratios, reinsurance, catastrophe accumulation, and changes in underwriting standards. Question 7. What is catastrophe risk, and how would you monitor it? Catastrophe risk is the possibility that a severe event creates losses beyond normal claims experience, such as a flood, earthquake, storm, or industrial accident. I would monitor insured sums, geographic accumulations, peril concentrations, probable maximum loss, model outputs, and reinsurance recoveries. I would compare results with risk appetite and test alternative scenarios because models contain assumptions and data limitations. For MAPFRE, strong monitoring should support underwriting capacity decisions, reinsurance purchases, and timely escalation when concentrations become excessive. Mention natural and man-made perils, exposure concentrations, accumulation management, catastrophe models, probable maximum loss, reinsurance, scenario analysis, model limitations, and escalation against risk appetite. Question 8. How do you evaluate market risk in an insurance portfolio? I would start by mapping asset and liability exposures, then measure sensitivities to interest rates, credit spreads, equities, currencies, inflation, and property values. Duration and gap analysis help assess rate risk, while stress tests show nonlinear or combined effects. I would distinguish the impact on asset values from the impact on technical provisions, because liabilities may move in the opposite direction. The conclusion should address limits, hedging, and asset-liability matching rather than focusing only on portfolio returns. Cover interest rate, equity, spread, currency, inflation, and property risks. Explain duration, sensitivity, scenario analysis, asset-liability matching, limits, and how market movements affect both assets and liabilities. Question 9. What is asset-liability management, and why does it matter to MAPFRE? Asset liability management coordinates investments with the timing, currency, duration, and uncertainty of insurance obligations. If an insurer owns short-duration assets against long-duration liabilities, reinvestment and interest rate risks may increase. The reverse can create liquidity problems. I would analyze cash flow matching, duration gaps, guarantees, surrender behavior, and stressed liquidity needs. For MAPFRE, effective OM protects solvency while allowing investment teams to earn appropriate returns within risk appetite and policyholder obligations. Explain matching asset cash flows, duration, currency, and liquidity to insurance liabilities. Include interest rate risk, reinvestment risk, guarantees, surrender behavior, and the role of OM in capital protection. Question 10. How would you assess credit and counterparty risk? I would assess credit risk by identifying counterparties, measuring exposure, reviewing ratings and financial strength, and estimating default and recovery assumptions. I would pay particular attention to reinsurance recoverables, bond issuers, banks, brokers, and derivatives counterparties. Concentration limits and collateral arrangements are also important. I would stress rating migrations, spread widening, and default, then evaluate the effect on capital and liquidity. The analysis should distinguish temporary valuation volatility from a genuine deterioration in recoverability. Be sure to discuss credit ratings, probability of default, loss given default, exposure at default, concentration limits, collateral, reinsurance recoverables, derivatives, and migration or downgrade scenarios. Question 11. How would you analyze reinsurance risk? I would review how reinsurance changes retained exposure, capital requirements, earnings volatility, and liquidity. Key items include retention, attachment points, limits, exclusions, reinstatement terms, recoverables, and counterparty quality. I would test whether protection responds to the actual risks, since basis risk can leave unexpected losses. I would also compare the cost of cover with the capital benefit and volatility reduction. A sound conclusion considers both protection and the possibility that a reinsurer pays late or fails. Cover ceded premiums, retention, treaty structure, recoverables, counterparty quality, basis risk, reinstatements, collateral, attachment points, limits, and the trade-off between capital relief and cost. Question 12. What is ORSA, and how would you contribute to it? ORSA is an insurer's forward-looking assessment of its own risks, solvency needs, and ability to remain within risk appetite over the business planning horizon. I would contribute by validating exposures, preparing stress and reverse stress scenarios, comparing projected capital with thresholds, and documenting management actions. I would link the analysis to strategy, underwriting plans, dividends, and investment decisions. The strongest ORSA is owned by the business and board, with risk analytics providing credible challenge and transparent evidence. Discuss the own risk and solvency assessment, forward-looking risk and capital assessment, business strategy, risk appetite, stress testing, governance, documentation, and communication to management and supervisors. Question 13. How would you design a stress test for MAPFRE? I would begin with a material risk and define a plausible but severe scenario, such as a catastrophe combined with equity losses, spread widening, and inflation. I would map impacts through claims, reserves, reinsurance, investments, capital, and liquidity. I would quantify both immediate and projected effects, then assess feasible management actions and recovery time. I would document assumptions, data limitations, and correlations, and include reverse stress testing to identify the conditions that could threaten solvency or business continuity. Mention scenario relevance, severity, plausibility, combined risks, balance sheet transmission, capital and liquidity impacts, management actions, reverse stress testing, and clear assumptions with limitations. Question 14. How do you distinguish risk appetite from risk limits? Risk appetite is the amount and type of risk MAPFRE is willing to accept to achieve its objectives. Risk limits convert that broad statement into measurable boundaries for exposures, concentrations, capital, liquidity, or volatility. I would also use early warning triggers below hard limits, assign owners, and define escalation actions. For example, appetite may allow a target catastrophe exposure, while limits cap geographic accumulation. Effective governance links board-approved appetite with daily monitoring and timely corrective decisions. Explain risk appetite as the strategic amount and type of risk accepted, while limits translate appetite into measurable controls, include thresholds, triggers, escalation, ownership, and board oversight. Question 15. How would you investigate a sudden deterioration in a loss ratio? I would first validate the data, definitions, period cutoffs, and any system changes. Then I would decompose the movement into claim frequency, severity, exposure, earned premium, mix, large losses, catastrophe events, inflation, and reserve development. I would compare actual results with pricing assumptions, budget, prior years, and peer segments. I would also assess whether reinsurance or claims reporting timing distorted the result. Finally, I would separate temporary noise from a structural underwriting problem and recommend targeted action. Focus on data validation, frequency versus severity, claims development, pricing, mix, inflation, catastrophe events, reserve changes, reporting timing, reinsurance, and comparison with budget and prior periods. Question 16. What role does data quality play in risk analysis? Risk analysis is only as reliable as its underlying data. I would check completeness, accuracy, consistency, timeliness, ownership, and reconciliation to finance or policy systems. I would investigate missing values, unusual movements, duplicate records, mapping errors, and changes in definitions. Data lineage should show how source fields reach reports or models. If quality is insufficient, I would quantify the limitation, apply controlled assumptions, escalate material issues, and create remediation actions rather than presenting false precision. Mention completeness, accuracy, consistency, timeliness, lineage, reconciliations, control totals, exception reports, governance, and the consequences of poor data for models, capital, reporting, and decisions. Question 17. How would you validate a risk model? I would validate a model through several lenses. First, I would assess conceptual design, assumptions, data quality, and implementation. Then I would test calibration, sensitivity to key parameters, stability over time, benchmark results, and outcomes against actual experience where available. Stress and reverse stress testing would reveal weaknesses outside normal conditions. I would document limitations, overlays, and model risk, and ensure independent review. Validation should conclude with clear remediation, monitoring indicators, and approval conditions. Cover conceptual soundness, data quality, assumptions, calibration, backtesting, benchmarking, sensitivity, stress testing, outcomes analysis, documentation, independent validation, and model limitations. Question 18. How do International Financial Reporting Standards 17 and Solvency II differ from a risk analyst's perspective? International Financial Reporting Standards 17 is an accounting framework for measuring and presenting insurance contracts, while Solvency II is primarily a prudential framework for assessing solvency and regulatory capital. Both use forward-looking assumptions, but their objectives, valuation rules, discounting, margins, and reporting differ. International Financial Reporting Standards 17 includes concepts such as the contractual service margin and insurance revenue. Solvency II emphasizes best estimate liabilities, risk margin, and capital requirements. I would reconcile differences carefully and avoid using one framework's result as a substitute for the other. Explain that International Financial Reporting Standards 17 is an accounting measurement and presentation framework, while Solvency II focuses on regulatory solvency. Mention contractual service margin, best estimate liabilities, margins, and capital reporting. Question 19. Describe a time you had to explain complex risk analysis to senior management. In one project, I explained that a portfolio's reported diversification understated its exposure to a common economic driver. I reduced the analysis to 3 messages: the concentration, the stressed capital impact, and the available actions. I used a simple chart rather than model terminology, answered questions with supporting detail, and clearly separated facts from assumptions. Management then approved tighter monitoring and a revised limit. The experience taught me that risk communication must be decision-focused, not technically impressive. Prepare a concise STAR example showing translation of technical analysis into business impact, use of visuals, prioritization, challenge handling, recommendations, and measurable outcome or follow-up. Question 20. Why do you want to join MAPFRE as a risk analyst? I want to join MAPFRE because its international insurance platform offers exposure to diverse products, markets, and risk profiles, making it a strong environment for developing as a risk professional. I am attracted to work that connects quantitative analysis with policyholder protection and sound business decisions. I would bring structured problem solving, attention to data quality, and the ability to explain findings clearly. MAPFRE's scale would let me learn from complex risks while contributing to disciplined, forward-looking risk management. Connect MAPFRE's international insurance platform, diversified business, policyholder purpose, risk culture, analytical development, and your skills in quantitative analysis, communication, controls, and judgment. If you are still with us, congratulations. You are much ahead of the rest and serious about preparing for your interview. We hope we were able to add value to your preparation and create some helpful content. Do not forget to like and share this video. Your small act can do great things for us.